In this video, I want to highlight fees and taxes in stock investing, understanding fees and taxes in stock investing. So, understanding fees and taxes is very important for optimizing returns in stock investing. So, here's a breakdown of key considerations when it comes to fees and when it comes to taxes as it relates to stock investing. So under fees in stock investing, we have number one is brokerage fees. Brokerage fees. Brokerage fees comprises trading commission as well as account maintenance fees. Brokerage trading commissions as well as account maintenance fees and also platform fees. So trading commission fees actually are charged by brokers for buying and selling of stocks. Many brokers now offer commission-free trades, but some may still charge fees. When you buy shares, it attracts fees, and when you sell, it equally attracts fees. It is called trading commissions. Apart from that, you have account maintenance fees. Account maintenance fees. So these particular fees are charged for maintaining an account, which may include monthly or annual fees to maintain your account with your stockbrokers. You equally have platform fees. Platform fees comprises costs associated with using certain trading platforms or tools. These particular fee has to do with your usage of the trading platforms or certain tools that are incorporated in the platform. Number three is management fees. Management fees. So management fees here comprises mutual funds and ETFs as well as advisory fees. So when it comes to mutual funds and ETFs, these are fees associated with actively managed mutual funds or ETFs, including management fees and expense ratio. When you invest in mutual funds, they usually charge management fees. It might be a percentage of the capital, or a percentage of the profit, as the case may be. They equally charge what is called expense ratios. We also have advisory fees. These are fees paid to financial advisors or portfolio managers for managing investments, often calculated as a percentage of assets under management. Usually they calculate this particular fees as a percentage of the assets or the capital under management. If a fund is running, let's say, $1 billion in asset under management, and they are charging 1% advisory fees, 10% is $100 million, 1% is $10 million. So $10 million out of $1 billion, is charged as is deducted as fees. Number three is transaction fees. So under transaction fees, you have bid-ask spread. Bid-ask spread. This is the difference between the buying price is called the bid and the selling price is called the ask, of a particular stock trade, which can affect, overall transaction cost. That difference between the bid price and the ask price is what is called the bid-ask spread. You equally have on custody fees. Custody fees, incorporate charges for holding securities in the brokerage account or custodial service. When your stockbroker holds, securities, in in your brokerage account, they charge what is called custody fees. Number 4 is fund fees. Fund fees, and these include performance fees. This particular fees is based on performance of a fund or portfolio, typically a percentage of profits. A typical example is hedge funds. They charge what is called 2 and 20. 20% of profits and 2% of capital. So in this case, the performance fee is a fixed percentage of the profits the fund is able to make, under a given period. You equally have load fees. So load fees, are associated with purchasing or redeeming shares in mutual funds, including front end and back end loads. So when you buy shares in mutual funds, it attracts what is called load fees. And when you redeem your shares, in other words, you sell your shares, it is called redemption. That redemption will equally attract what is equally known as load fees. When you buy, it attracts load fees. When you sell or you redeem, it equally attracts load fees. Number 5 is miscellaneous fees. You have wire transfer fees, that's cost of transferring funds between accounts or to other financial institutions, as the case may be. And the other one is account inactivity fees. Fees charged if an account remains inactive for a certain period. If your account is inactive, you don't buy, you don't sell, it remains like, should I say, dormant for a long period of time. That period of inactivity will attract what is called inactivity fees. So we now go to taxes in stock investing. We've dealt with fees in stock investing. Fees in stock investing include brokerage fees, management fees, transaction fees, fund fees, as well as miscellaneous fees. And when it comes to taxes in stock investing, you have what is called the capital gain tax. Capital gain tax. So short-term capital gains, are taxed at a higher rate. So profit from the sale of stocks held for 1 year or less taxed at the investor's ordinary income tax rate. Usually when you hold your shares for a particular length of time, you attract what is called capital gain tax. Whenever you sell your shares, you will then end up paying a capital gain tax, depending on how long you hold on to your investment. So under taxes and under taxes, you have capital gain tax, short-term capital gain tax. If you hold your investment for a shorter, length of time, it attracts, a bigger amount of tax. You equally have long-term capital gain. So profit from the sales of stock held for more than a year is taxed, at a lower rate than short-term gains. So the lower your holding periods, the lesser the tax it attracts, and the longer your holding periods, the shorter your holding periods, the higher the amount of tax it incurs, and the longer your holding period, the smaller the amount you will pay, you'll be charged as tax. So short-term capital gain, bigger tax. Long-term capital gain, smaller amount of tax. And number 2 is dividend tax. Dividend taxes. So we have what is called qualified dividend. Dividend paid by U.S. corporations on shares held for a specific period, tax at the long-term capital gain rate. So usually when it comes to qualified dividends, the long-term capital gain tax rate applies to this particular dividend. You also have ordinary dividends. When it comes to ordinary dividends, dividends that do not meet the criteria for qualified dividends are taxed at the investor's ordinary income tax rate. So depending on it is charged based on your tax bracket. For ordinary dividends, you are taxed based on your normal income tax bracket. For qualified dividends, you are taxed based on the long-term capital gain rates. Apart from that, you have number 3, wash sell rule. Wash sell rule. So this this it's a rule that disallows the deduction of a loss on a sale if the same or substantially identical stock is purchased within 30 days before or after the sale. Usually when you sell at a loss, you don't get taxed because you are selling at a loss. As long as you purchase an identical stock within 30 days, you have that tax exemption kind of. So you have what is called impacts under wash sale rules. It can affect the ability to claim tax deduction for losses, depending on the circumstances of the trade. You may not be able to claim tax deduction for losses. Number 4 is tax advantage account. Tax advantage account. You have individual retirement accounts, your IRA. So this particular account, offers tax benefits, because they have that tax deferred growth, like your traditional IRA, or tax-free withdrawal, like your Roth IRA. Your fund will compound at the tax-free rates, and when it comes to withdrawal, you don't, pay tax. So you equally have the 401k account. So employers sponsored retirement plans with tax advantages, including pre-tax contribution, that's your traditional 401ks, or after-tax contribution, like your Roth 401k. So all these ones are, tax advantage accounts. You have that benefits of not being taxed almost at all. Number 5 is tax loss harvesting. Tax loss harvesting is a strategy of selling investment at a loss to offset capital gain and reduce taxable income. When you sell your investment at a loss, you tend to pay less. It reduces your taxable income. You equally have what is called execution. This involves selling underperforming stocks to realize losses and reinvest in order to, in other assets to maintain portfolio allocation. When you sell at a loss, so as to be able to buy, other assets within the same portfolio, you have that tax loss harvesting is applicable to this particular transaction. You equally have number 6, net investment tax. Net investment tax is an additional, tax of about 3.8%, on net investment income for high income earners, including interest, dividend, and capital gains. So you are taxed at a rate of 3.8% because you are a high income earner. You have what is called threshold. It applies to individuals with modified adjusted gross income above certain threshold. When you exceed a particular threshold, this level of tax applies to you. Number 7 is state and local taxes. State and local taxes, it involves variability. So tax rate and rules can vary by state and locality, affecting overall tax liability on the investment income. So in this particular context here, you discover that different regions or different states have local tax that applies to investors in that particular state. Some tax a higher rate, some tax a lower rate, and that will then determine the overall amount you are going to make at the end of the day as an investor. So understanding and managing fees and taxes can significantly impact your overall investment returns and financial planning. By staying informed and implementing uh, effective strategies, you can maximize the benefits of your stock investment. So make sure you understand these taxes and where they apply, so that you will be able to reap the benefits where possible, and avoid the negativity involved in them these fees and taxes where possible.